IPO market and the companies going public was always this celebration of, maturation of the company and the opportunity for regular folks like you and I to go and actually participate in something exciting that's going to grow and contribute to our future, to our kids' college funds, to us potentially buying a new house or leaving a little bit of a nest egg for the future generation. None of this is true anymore. And this entire industry kind of like evolved in this like mini Jenga of issues that I think now create a situation where, although it's not financial advice, I would strongly discourage anyone who is a regular retail investor to go and participate in IPOs. And frankly, if you're a company investment shop and you have money to burn, that's also not the place where I would put it. But to each their own. Here's the reason why I think it's a bad idea. So, one of those concepts that evolved in this industry is that it used to be that you join the company through the initial public offering at the very kind of like start of their maturation process, right? You're entering at the base level, maybe not at the ground level where all the original investors started and the founding company, but you're kind of like a step above, and then you keep growing with them and taking advantage of that growth in the equity. Now you're entering at the very top. So it's like they squeezed as much as possible from the private markets, and now they're ready to go public because that's another way for them to source capital or for exit liquidity, which we're going to talk about in a second. And then you essentially buying in at the top, and you're not even sure how far further can they grow, and you take on this down risk potential. And to support this kind of like claim, if you look at this quick stat, I essentially pulled, and it's again the OG IPOs, so old IPOs from the 90s and like I think almost up to 2000s at the current dollar values, right? So the actual dollar values when and valuations of the companies when those companies went public were in then numbers. I just converted them, assuming the inflation, into the current numbers. It took me way longer to explain it than I should have. But in any way, as you can see, like Microsoft, Netscape, Amazon, when they all went public, their valuations were sub $2 billion in the current dollar value. Where if you look at the upcoming, this like three biggest IPOs that are happening right now, and I totally get it, right? Like there might be big exclusions from the rule, but that's still the reality of things. They're not that far off from a lot of other IPOs that are potentially being mulled over there. And the idea is that SpaceX is like at 1.7, 1.8 trillion, OpenAI at about a trillion, maybe a little bit under, and Anthropic also at about a trillion or a little bit under. So you're already entering very mature companies at a very high level of valuation. And if you are participating in this, your assumption would be then, oh, they can actually go and like continue growing at this pace, which I highly question, right? And I made the whole video about SpaceX a couple of weeks ago. You can go check it out, where I break down how unrealistic this number is. But I don't have access to OpenAI and Anthropic numbers. The rumor has it Anthropic is profitable, and they do have pretty healthy enterprise business. But even then, at that point, like how much and how much further can they push it, right? So you're definitely buying in at the top versus kind of like, as I said, in the past when, say, Microsoft or Netscape and Amazon went public, now Netscape is no longer around, but like Microsoft and Amazon, they're trillion plus, right? In trillions, their valuations. So if you bought in at that value, you 1000x your potential share value, right? Like assuming you're still holding their stock. So like, will this 10x? Absolutely not. Like I can tell you right now, they won't, no matter what they tell you. They're not 10xing, right, from that point. Unless it's inflation and again, dollar just like completely diluted in valuation. That's how they got to 10x, but in reality, in the real purchasing power, the value of that stock is much less. So that's one piece of the Jenga. The other piece of the Jenga is, again, you heard me if you have been on my channel, but for the sake of anyone who's clicking on for the first time, today it's all about vibes versus fundamentals. That's how they get to these numbers. Like SpaceX, again, a little bit of spoiler alert for my main video, but all of it is vibes. All of it's about like, oh, we're gonna do these amazing things, and we're gonna invest, and we're gonna do these cool things. Believe us, like trust us, bro. Like we're gonna get there, without any hard investments committed, without any hard IPs generated, without any kind of preliminary work done. They're just saying like, hey, just vibe with us. Imagine the world. We're gonna get to this number. How cool will it be? How rich will you be if you're gonna buy in with us right now? That's the conversation. Versus in the past, it would have been like, how much money you're making, how profitable you are. If you're not profitable, can you turn profitable? What will it take? Oh, can you expand international? Can you expand in a new region? Can you acquire maybe another company and grow this way, right? The conversations were about fundamental financial performance. And again, this is where we need to get back to. While we're in the world where it's all about the vibes, all of these IPOs that are coming up right now, I highly question them, because if they don't show actual financial performance, how can I trust that the team can execute if they yet to execute, right? Like it's a very simple rule. Like even if you don't believe and you're like, hey, but fundamental models can be outdated and whatnot, just ask this question. If someone comes to you and says, hey, I'm going to run a marathon sub 3 hours, and you ask them like, what you've been running at? They're like 5 hours. Okay, when are you going to do it? Next week. So how believable does that sound, right? And I'm saying, again, might be a bad metaphor, but you just have to look at the realistic expectation of if the company have not executed at a certain level and they promise in the short term to execute at the level which is like X amounts of higher than that, can you really trust it? Like what was stopping them before executing at this level, right? Like if you have not shown level of performance before, how can I trust and believe that you actually have the capacity to reach that level going forward, right? It's again, natural skepticism. That might be the reason why there's truth to what they're saying, but you have to be skeptical because you're putting your hard-earned money into something like this. Now, the next one that we should talk about is the special purpose acquisition companies. So SPACs. You've heard that term before, SPAC, the SPAC. The whole idea of the special purpose acquisition company is essentially someone creates like a shell company and lists it publicly, right? They usually like pick a share price, say $10 per share. I think that's actually what they usually go with. And there's some backers, right? There's some backers who underwrite that investment. Benefit for them in the future when the transaction happens, they're going to get a little something, something. Benefit for the company that participates later on in the SPAC is the fact that you don't go through the whole scrutiny of S1 and like you don't have to go open kimono to everything that you've done before, all of your financial performance, like what SpaceX did, which gives me very foundational information to go and criticize the evaluation. A lot of companies try to avoid it, and to avoid it, essentially what happens, you have this shell company, you find a target company which wants to go public, and that shell company technically acquires that company, and they convert. Instead of now they have a ticker symbol of this, they actually rename that ticker symbol to the actual name of the company, whatever the company prefers, and they skip all this pre-IPO song and dance where you have to you go file S1, you have to go in front of the investors, answer a bunch of different questions about people asking you why would you be evaluating a company at a certain level. You get to skip all of this, all the regulatory requirements, right? You essentially just, hey, my company just got acquired by another public company, so we're just now public, and that's it, right? And they stop performing. The issue with that, as you can imagine, there's a lot, but I kind of collected these few fun facts. There's roughly 43% cost to the number of money the underlying company that's being merged into SPAC being charged compared to if they would list publicly. And I won't go into details through all of this, but basically think about it this way. There are some obviously bank fees, and any other company that goes public, they pay underwriting banks anyway. So that's not unusual. But what unusual is that people who initially put their money into an original SPAC when it's listed, they get a lot of rights to the shares at a predetermined price that they can call upon, or there's certain allocation when the target company is merged in. People who created the SPAC, they usually get something like 20% of that stock. So for anything that's listed, say for any 5 shares listed, right, there's 1 share being issued to that company for free. So there's dilution that's happened. So between the dilution and the bank fees, you basically lose $4, right, to $4.4 30 cents on every $10 that the company raises. So it's actually very costly. And then if you look at, again, coming back to the vibes versus fundamentals, every one of those are promising because they have to kind of entice investors and say hey, yes, SPACs are risky, but this is why you're going to be great. We forecast 100+% on average growth. And really only about a third of them ever even makes it to the forecasted growth. And very likely, I haven't looked at all of the data because I was just reading a research paper on this. If you would if you would kind of read through the list, I bet you a lot of these people who met, they were just more conservative and realistic about their growth forecast versus anyone who promised ridiculous moon in the sky. They all failed to deliver, right? And finally, the average return, right, for all of these SPACs is about between 13 to 27 negative. So they actually contract your value. And the longer you take, the more value you lose, the less value you essentially retain in those SPACs. So it's highly unprofitable. It's pretty much used as a liquidity event for a bunch of investors, which we're going to talk about in a second, and allows you to skip a bunch of, again, regulatory environment frictions, and also being able to be criticized by the public when you file an S1. So super shady. Even outside of this, I would say never touch SPACs, but again, not financial advice. To each their own. It just I think this should be sufficient enough to know that this is not a good thing, period. There's no argument to that. And finally, what I've been talking about a couple of times, or referred to a couple of times, the whole idea about being in the exit liquidity for the venture capital and the PEs. And this is kind of like ties to a lot of these other parts, right? Over the years, we've kind of like seen this trend where initially when these companies at the early stages, right? Like, again, I'm thinking Amazon's, like Netscape's, Microsoft of the world, the amount of investments they took up front before they listed were a lot less than it is today. Today, VCs and PE, so private equities, they invest like billions and hundreds of billions of dollars before the company ever makes it to the market. So there's a ton of money invested in the company before it is listed. And obviously for these investors, that becomes kind of like their only exit opportunity. Like again, looking back at someone like SpaceX, OpenAI, Anthropic, back in the day, before going public as a company, and I've been in those companies where you're sitting there mulling over that decision, you basically have two ways to return money to your investors, right? Who join in early on and now, kind of like 5-6 years later, want to see that return coming to their bank account. You would have a choice between going strategic, what's called, right? You find basically a company that would acquire you, maybe in the same space, they're bigger, they have more access to capital, more people, and you just have certain part of niche of the market that they're not as good at, and they acquire you, they pay you a certain premium on the value of your company, and you basically distribute that cash throughout your organization, and people who own the stock or options in it get paid on it, right? So highly beneficial. That's one of the paths. The second path can be, hey, you go kind of like private equity route and you find a PE shop that goes and acquires you, places their own team. Again, they pay you the premium. It's very similar to the strategic in the sense of like there is cash liquidity event happens, and then the only difference, say, between the strategic acquisition is that who owns the company is now maybe not the company within the same niche, but rather a private equity fund that has several of those portfolio companies and they manage them together. And then final would be the IPO. So you would go public, and that's your path, right? And that's you use the proceeds from the IPO to pay people for the shares that you list, or you go and also distribute the cash that you raise in the market for some other purposes, right? So quite a few opportunities. And with an IPO, technically, like your investors sell their stock, so structures can differ, right? Of who and how much of a float they introduce. But the whole idea is that there were a lot of options. For these, there is no strategic acquirer out there that can afford buying them, right? Bar Nvidia and Apple. And neither of those companies should ever touch any of these companies at acquisition unless they're like way cheaper than that. So no one can acquire them. There's no PE shop that can raise this much money at depth and have enough cash flow within those companies or themselves to cover the interest payments. So IPO is the only chance basically to provide the return to your investors. And that's what investors are basically out there expecting you, right? And so they're pushing you, they essentially have liabilities to them or promises, whichever way you structure them, to go and list the company. So you're rushing towards it. And you can see it kind of like in the data. That's why I call it like a old man game, because these companies become a lot more mature, right? Back in the day, I was a little bit more. The median age of the company doing IPO, that should say IPO, and median as well. Pardon. There you go. The median age of these companies, right, was 5 to 8 years. And now we're at like 14 years. So pretty mature companies. Again, in the past, there were Series A or B. And if you're not familiar, basically, it's all that it means past like initial rounds of funding. When you get a little bit more serious and start building actual like pretty firm organization, you have product market fit, you understand how to make money, you actually have a product to sell. You usually raise like Series A, which is like the first series round, and then goes into the B, and then you would go public at that point, right? And the lettering, all that it means is just what is the sequence, right? Like A, B, C, D, E. So the further down the alphabet you go, the more mature and more late stage investment round it is, which usually means you have higher and higher valuation, and you're potentially also raising more and more money, right? And at some points it gets to this interesting scenario where any potential IPO would actually raise you less than what you're going to get from the market. But the problem is you need to give people money back. They're pushing you, and so this is why you basically rush and you try to figure out how can I structure myself, like in the SpaceX scenario, and put the money out there, put the company out there so I can get the money and pay back my investors. And notice how in all of this, what I've been describing, all of this conversation, I wasn't talking about shareholder value, I wasn't talking about employees of the company, I wasn't talking about like the customers, right? All of it is pretty much keeps coming back to the fact that the company owes some investor money and they need to give it back. And it just got to the point where, because of all these vibes and all the promises that they made, they probably and usually owe a lot of money to those people, right? And those investors are expecting a lot from them. So the priority starts shifting away from what it should be usually, right? Which is, hey, what are the customers? How can we serve customers better? How can we maybe go early public in the case of like those younger companies, get this cash because we can build these new products, we can, unlock some growth vectors, provide more value to our customers, right? Like this is a healthier philosophy, right, to how you approach IPOs. And again, other companies there, in the past, I'm not also like gonna absolve them. I'm sure there were in the past plenty of companies who still would go IPO for exactly the same reasons. But I'm just saying, in the natural world, in the company that I would manage, I would want to do something like this, not only because I'm returning money to investors, but because it unlocks me an opportunity to do something more for my customers, because that's ultimately what matters, right? But none of these care about that stuff. All they really care about is that, hey, made a bunch of promises to a lot of these very powerful people. I want to maybe remain in this, industry beyond my current company. So I should do my best to give them as much as possible, because even if the company crashes and burns under the weight of whatever, the debt raised or the fact that IPO is underperforming, yes, I might get fired, but guess what? All these powerful people still think well of me. So next time around, when I'm creating another company, I can still go back to them and say, hey, invest a few hundred millions with me. I'm going to do the same thing and build, and I'm at least going to return you the same amount of money, or hopefully more, right? That's what they're thinking about. They're not, again, thinking about the customer or the employees or anything else. They're just thinking about maintaining good relationships with those powerful people. That's an entire philosophy here. Like, genuinely. You don't have to dig deeper than that. And so, with that philosophical approach, how can you expect from today's world of these mature companies going public that any of it is aimed at anything but that, right? You cannot. And so that's where you see a lot of these newer IPOs that are happening. A lot of them are crashing and burning. A lot of them going delisted. They're getting delisted, or they're going private again, right? They're underperforming because the underlying factors were just not there. They were not ready. They were not performing well. They didn't have the product market fit. They didn't have the good business model set up. They just rushed towards it because they owed someone very powerful a lot of money, and they just needed to get it out of the market. And that's why, like, when you look at all of this news, and what pisses me off about like the SpaceX valuation, as much as like I genuinely love the company and what it does and the future that it potentially builds towards, right, with the reusable rockets and starships. But when I look at it from the perspective of, oh, they're now doing all sorts of rule changes, they're lowering the limits on the retail investor fund amounts to be able to invest in this IPO. Everything is being done to pull as much liquidity as possible, as much cash as possible from regular folks like you and me to fund this return of money to all these rich and powerful people. And then what's going to happen next, I genuinely promise you that I don't care. Like, you can read through all the risks and everything that they're discussing. And again, SpaceX is a good example. In the S1 filing, everything is basically saying like, hey, we don't know how we're going to do any of this, but trust us, do it, right? And even all these deals that they're trying to close right before the IPO with like Google, with Anthropic, are all like cancelable deals, again, to just drum up the PR for the regular folks to be like, yeah, but look, they're going to be making billions and billions of dollars. It's going to be so cool. But once IPO happens, the cash leaves your bank account and enters the bank account of some massive, financial investor, family office and whatnot. They're going to be like, oh, but oops, all these contracts were canceled. Yeah, we didn't deliver, but we'll try better next time. Still believe in us, still hold that stock. We're going to be okay. Well, the stock craters by like 50%, right? It's annoying. That's all I'm going to say. So again, I have to stop myself sometimes in these videos before it gets too ranty. It's a very perverted world of wrong incentives that we've created in this industry right now. And this is why, like, I have less and less trust in the public markets the more I see these events, because again, it keeps coming back to the fact that it's a game of musical chairs. You're one of those players, but the other players know exactly when the music will stop, and they will jump in front of you and grab that chair, and you're going to be the one left standing, holding that bag for all of them. So I hope this was helpful. I hope if you were considering, doing some of the investment around IPOs, you decided not to. Not financial advice, but I'll see you next Saturday ranting about some other new topic in tech world, in world of creators, or hopefully, I don't know, maybe someone else will file an S filing and we're going to get to come through some big company like Anthropic or OpenAI's disclosures to see what exactly going on in their business. Peace.